Good evening, good afternoon, good morning, wherever you happen to be. I'm Brad Alexander, and I'd like to welcome you to the Fintokei Tariffs as a Trading Opportunity webinar. Before we get going, if anybody who's listening, just pop your name into the chat. I want to make sure our audio is okay, you can see everything. And I'd like to know from where you're viewing. Fintokei has clients all over the world, some good prop traders, and we'd like to see where you are. So anyway, we live in very strange times, and if you're trading right now, you're finding it a little difficult. You're not alone. I'll go into more details later, but I spent a lot of time doing market analysis during the first Trump administration, trading and analyzing the markets. When Joe Biden came into power, it was much easier, and I've been warning a lot of friends and family and traders about the current administration, and there's been some blown up accounts, sadly. So let's see if we can help you traders to avoid blowing up your accounts and actually turn it around, make some profits. So let's get going. So, as I said, my name is Brad Alexander. I've been a retail and professional trader for many years. I also do a lot of market analysis. I do videos for brokers. I do audio and content for fintech companies. I've been in the business for many years. People ask me, how long have you been trading? And I say, well, I used to trade the peseta. So Google that and you can find out how long I've been trading. I used to trade the hard way through the banks. My clients day to day are brokers in fintech, and I've worked for the Fintokei people and the Purple group for many years, so I know them quite well. I also do consulting services for brokers in terms of banking, licensing, etc. So I've been in the business a long time. So who is Fintokei? Please let me know in the chat if you're an existing Fintokei customer, or you're just taking a look, or are you interested in getting going with prop trading and funded trading in Fintokei. So Fintokei is an award-winning prop firm backed by the Purple Group. And the award that we won last year was the most popular broker-backed prop firm. Broker-backed prop firm is an important accolade because there are so many prop firms out there that simply do not have the backing or simply do not have the infrastructure to service their clients, handle the liquidity, and basically provide the instruments at the best spreads and the best execution speeds that you really need. So one of the benefits of being backed by the Purple Group is that they have everything that you need and the best service. You can get going with Fintokei in 3 different modes. There's a beginner start trader account with accounts up to $100,000. There's the ProTrader with accounts up to $400,000, or there's a Swift Trader, which has the fastest evaluation phase. You can get going literally earning from day one, and you're required to pay a fee for each one, and the size of the account depends on the fee you pay. The good news is, if you hang into the end of the webinar, we've got a special surprise for 50 traders who want to sign up for Fintokei. Fintokei's average payout last year was $3,881, which is very high compared to some others, and they also pay out within 1 business day. And I can also tell you from experience of people I know that sometimes a lot of prop firms aren't offering anything like that in terms of speed and payout. Also, if you have any questions during the webinar, please feel free to pop it on the chat line. So, what are we going to be talking about today? Well, the agenda is quite clear. We're talking about not just tariffs, but anything to do with fundamental analysis. And we'll be going through all that as we plow through our slides and our time here. And again, please feel free to ask questions. What I want to go through is talking about fundamental versus technical analysis. Basically, if you understand the difference between the two, fundamental analysis is basically what happens in the news. Technical is what happens on the charts. So anything to do with tariffs is definitely a fundamental event. I want to talk about tariffs, the concepts, and the history of tariffs, and why they're not such a good thing. And we want to talk specifically about the Donald Trump tariff philosophy. I mean, you may have heard Donald Trump saying that the tariff is the most beautiful word in the dictionary. Well, he seems to be the only one who thinks that, and I'm going to try to keep things empirical and subjective, but it's very difficult if you're trading watching the markets bounce around and not blaming Donald Trump. I also want to talk about the role of the U.S. Federal Reserve and central banking in general. I wasn't really going to include central banks in this webinar, but Donald Trump changed my mind about 2 days ago, or actually, in fact, yeah, it was earlier this week, and I'll explain why as we go. So we want to take a look at as well the effects on the indices that the tariffs are having. Obviously, with Fintokei, you can trade a variety of indices from around the world. I believe there are about 10 of them. There's three major U.S. indices, European and Asian indices, and the Australian, and they're all being affected by these tariffs pretty much in lockstep, in tandem. We want to take a look at effects on commodities. I mean, the main commodity that we need to look at is crude oil, Brent crude or WTI, because the tariffs will be affecting basically what happens on the planet, whether it's supply and demand of oil, production capabilities of places like China, which will have a definite effect on the demand for oil. Also want to take a look at the effects on currencies. Obviously, as you know, when you're trading indices, it's basically up is good, down is bad. Currencies, of course, are binary. They can go up, they can go down, depending on the pair you're trading. And there's as you know, there are quite a variety of currencies to trade on the Fintokei platforms. And of course, we want to look at the future. And this is the most difficult part because, and again, trying not to be mean or biased, is that we just don't know what's around the corner with this current U.S. administration. You've got every other world leader on the planet trying to impart some wisdom onto the White House, and it's simply not working. There have been signs this week where he's starting to catch on, and I'll explain that as we go. But again, I wouldn't count on any dramatic improvements in that area. I'll give you an example. During the first Trump administration, and I watch Bloomberg a lot. That's where I get my news from. I remember the manager of ultra high net worth for Goldman Sachs was on an interview, and she was just saying, we don't know what to tell our clients. It's just up and down. We don't know what's happening. And in those days, it was all based on the U.S.-China trade wars, and then of course COVID came in. So when I was doing my market analysis, I was like a broken record. U.S.-China, U.S.-China, U.S.-China. Depending which way it was going would drive the markets. And then of course the pandemic came along. It was all about vaccines. Good news on vaccines drove the markets up. No news on vaccines brought everything down. So here we are again, but with the tariffs, and it's basically Trump 1.0 on steroids, because the dramatic changes that we see day to day are just phenomenal. Okay, so I want to talk about fundamental analysis. Fundamental analysis is basically when price is driven by economic news. So hopefully as traders on the Fintokei platform, you're looking at the economic calendar every day, because economic news, whether it's interest rate decisions or CPI, inflation reports, employment reports, all drive the markets. In fact, the biggest market mover normally, and I say normally, is the non-farm payrolls from the United States, and that happens the first Friday of every month. So that'll be along, I guess, next week. So we look at we call these calendar events, and this is actually a nice way to trade. I mean, I do most of my trading this way, and I'll explain that as I go. It's actually a very effective way to trade, trading the news events. Not necessarily trying to predict the news events, because that doesn't always work for people, but taking the reversals and the rebounds after the news, and I'll explain how to do that. One thing we need to look at in terms of economic news and fundamental analysis, and I say in my chart here, planned versus surprise. Well, planned is anything you know it's coming, whether it's an OPEC meeting or the non-farm payroll report, or a surprise. And you're seeing that now with this up and down. One person in the administration says this, and then Donald Trump contradicts them, and then he says one thing, and then China says something else. And this is just the same as it was in the first term of Trump, but now it's multiplied by how many fold? We just don't know. So we need to take into account fundamental analysis. The magnitude of the events will dictate how much price action is driven. So, for example, if you want to trade the New Zealand dairy report, you can actually do it quite well and predict X amount of pips every time the report is wrong, up or down. But then you've got, on the other side, magnitude of events becomes much higher when you have things like trade wars. So now we're getting into this insane 145% tariffs of goods coming from China, and China's reciprocating, and we're getting back into the same mess. But this time it's different. We've got every country on the planet who are offering different ideas and different reciprocity trades and completely changing their supply chains. And this is going to take a long time to get out of it. Also, something that happens is real news versus fake news. And we've seen that a lot. I mean, I've been trading news items for years and years. And during Brexit, for example, trading the pound and the FTSE, Scottish independence referendums, when polls were coming out over the weekends and driving the markets on the Monday, that was one thing. But what we're getting out of the United States, and this is the same as the first term, we're getting fake news versus real news, and you really don't know what's going to happen. And I'm going to be showing clear examples of what that means. Okay. Hopefully you all know what technical analysis is. Technical analysis is price action predicted by past performance, and we're using lagging versus leading indicators to indicate on our charts how we're going to hopefully predict future pricing. Obviously, this does not always work. I'm going to be showing you in a few minutes how to combine fundamental analysis with technical analysis. Like I say, normally during the Biden administration, using technical analysis was enough because the fundamental events weren't driving price all up and down, but you still needed to be aware of fundamentals versus technicals. So if you're not familiar with technical analysis, you really need to study up on it. I wish I could spend hours and hours talking about it now, but I'm just going to skim through it. So basically, study your indicators and your time frames. Look at different time frames on different instruments, because you'll find the indicators will behave differently on different time frames. And as I say in the slide here, backtest, backtest, and backtest. So you can see on my little chart here, I've combined a chart pattern with the stochastic oscillator and MACD. That's not always the way to go. Some people like moving average crosses. Some people just like moving averages on their own. Some traders use the parabolic SAR. Some people use naked charts, and they just use support and resistance. There are many, many ways to perform technical analysis. And of course, once you find your favorite strategy, create your trading plan and stick to it. Okay, so this is my order of analysis. I've used this forever. So I don't get into a trade unless I see all 5 of these conditions. I'm comfortable with all 5, maybe just 4. But as you can see by the order, fundamental analysis always comes first. And that can mean I'm not going to trade the US dollar because I know in 3 hours the non-farm payrolls is coming up, or I just found out yesterday that Donald Trump is increasing tariffs on Sweden by 20%, or. So you need to understand the fundamentals of every pair you're trading, whether it's oil, whether it's indices, whether there's so let's say, for example, you want to trade the S&P 500, but in 2 hours' time, there's an earnings report coming out from General Motors and the Bank of America. You need to be aware that those big earnings reports on those companies will drive the indices. And again, fundamental events coming up on the calendar will drive currencies. An OPEC meeting will drive the price of oil, and anything can drive the price of gold. For example, whenever geopolitical events in, say, the Suez Canal, where a rebel group is trying to take over an oil tanker, the price of gold will shoot up. Once the event has calmed down, it will come down again. So once I've got my fundamentals under control, which is almost always impossible, once I have comfortable with my fundamentals, then I look at support and resistance. Support and resistance is one of the most important things. If somebody asks me what's my favorite technical indicator, it's the horizontal line. You need to be able to plot your support and resistance on every chart. There's nothing like going long on an instrument, and then you realize too late that you're actually at resistance, and then price action backs up. Next, I like to use chart patterns. whether it's rising wedges, falling wedges, triangles, pennants, whatever. I swear by them. They're great. Indicators, of course, whether it's moving average crosses. I also swear by the stochastic oscillator. If you find that you use the stochastic oscillator and do a lot of back testing, and I'm going to show you some examples in this webinar, that you'll find that it is a very, very reliable indicator. And I also use chart stick patterns, or candlestick patterns. Not always, but very often you may find a morning star or a hammer candle at the very point where you want to look for a reversal. And if that candlestick pattern, whether it's a single candlestick, a dual or a triple or more, lines up with another indicator like a moving average cross or stochastic oscillator, it can be very, very valuable. But I'm going to repeat again, fundamental analysis comes first. Okay, let's talk about tariffs. So the concept of tariffs. For many, many years, it's been proven, well, for decades and almost centuries, that globalization works. It's quite simple. Countries that buy from each other keep their tariffs low, as long as each country behaves and follows their tariff agreements, the world seems to work a lot better. I mean, for example, there are certain things that countries cannot produce. They have to import them. I mean, for example, it would be ridiculous for Sweden to put a big tariff on mangoes because they simply can't grow them. Mangoes going to Sweden probably go in at zero tariffs because there's no threat to the mango business in Sweden. The other side of the coin of globalization is populism, and that's where a country will want to do everything themselves, keep all their industry within their borders. And for many, many reasons, it just simply doesn't work. And populism has been evolving over literally decades and perhaps centuries because things evolve. For example, United States of America used to be a huge steel producer. Well, it just became too expensive to do. And there are many, many, many industries that simply will not thrive in certain countries because it's much easier to get products, whether it's agricultural or technical, from other countries because they can do it better. For example, I believe 98% of shoes in the United States are actually made outside the country because the cost of labor is simply too high in the United States. I remember watching the Davos Economic Forum in 2017, and they were asking every bank president, bank chairman, central bank chairman, world leaders, what's the biggest threat to the global economy? And they all said the same thing, populism. And that was in 2017. Unfortunately, populism is coming back into vogue now, and that happens when economies start to fail or falter. But unfortunately, it's coming back in spades in the United States. The historical results of globalization versus populism are quite clear. Globalization works. Right, so specifically we're looking at North America right now because the problems have originated in the White House in Washington, and the biggest trading partners of the United States are, of course, Canada and Mexico. So it's actually puzzling to everyone why this agreement, USCMA trade agreement, which is United States, Canada, Mexico trade agreement, is suddenly the worst trade agreement ever written, according to Donald Trump, because he wrote it. When he came into power in his first term, there was an agreement called NAFTA, North American Free Trade Agreement. He didn't like that, so they all got together, the three countries, and created the USMCA. And Donald Trump, I guess it was back in 2018 when it was finally signed, said it was the best trade agreement ever. Now he's saying it's the worst trade agreement ever. And the trade tariffs started with Canada and Mexico. And basically, as you know, he was saying, and I'm trying not to be biased or get mean about this, but we have to go with what he said, that the whole world, especially Canada, is taking advantage of the United States, which simply isn't true. Everybody's ripping us off, which simply isn't true. If a country feels like somebody else has a better advantage than they do with a trade surplus or a trade deficit, then you simply renegotiate. And some of these trade negotiations can take years and years to do. So, and Donald Trump has only 4 years to do all this, and why he thinks he's going to be able to do this in the next 90 days is anybody's guess. But one of the things that really confused a lot of people, he was saying that they're subsidizing Canada, which is completely untrue. There are no subsidies. He was saying that there are 300%, 250, 300% tariffs on dairy products, which is fantasy, that they just don't exist. Many trade agreements have floodgate conditions in them so that a country cannot flood the market with a certain commodity, and they almost never reach those tariffs, those quotas. So, in fact, if you take out oil, I'm specifically talking about Canada-U.S. trade agreements, and they're the biggest trading partners in the world right now, or at least they were. And by the way, I'm Canadian, so I'm trying not to be biased. The trade across the border is absolutely phenomenal. In fact, if you remove oil from that equation, the United States has a trade surplus with Canada, not a trading deficit. So and Donald Trump's saying, oh, we don't need them, we don't need Canada, we have lots of timber, we have lots of oil, we have lots of steel, we have lots of aluminum. Well, they don't, because they don't have the right kind. The oil coming from Canada is totally different than West Texas Intermediate. It's much heavier. The refineries in the States are geared up to process that oil, so you can't just change it overnight. In fact, if you talk about making cars, and this is one of the big bugaboos about some of these parts go back and forth across the Canadian border, American border, 8 times before they become a car. There's about 40,000 parts in one single car, and these parts come from 40 different countries. So it's not a matter of just snapping your fingers and making these tariffs make sense. So another thing is, who actually pays the tariffs? For weeks, months, Donald Trump was saying that the countries that they're ripping us off are paying the tariffs. Well, that's not true at all. It's the American importers that pay the tariffs. It's the importers in every other country that pay the tariffs. And it was only yesterday that Donald Trump actually admitted that that is the case. He said it's going to cause importing for our people, his industry, going to cost more money. He literally didn't say that until yesterday. What can you say? So he's finally either realizing it or someone's clued him in. In fact, there was a gentleman on Bloomberg literally 2 days ago who finally understood that he had to pay tariffs. He just thought that he was going to be importing goods from other countries and they would pay the tariffs. He got the goods, he tried to receive the goods in the United States and realized he had to pay tens of thousands of dollars in tariffs before the goods were released. So it's even now, people still don't understand who pays the tariffs. It is basically a tax on American importers. It doesn't matter if you're bringing in pencils or toys or oil, you have to pay the tariff before it comes in. Okay, let's take a look at a quick history of the tariffs before we get into some real details. And again, I'm going to repeat, the same patterns have appeared over and over and over again for literally centuries. So the very first big one was the McKinley tariffs in 1890. McKinley was a representative. He wasn't president then. He was a representative in Congress in the United States. The United States was suffering with debt because of the Civil War, which was many years beforehand. So he decided that he was going to protect American industry by putting tariffs on other countries. And it just became miserable. Within 3 years, there was a global depression. First of all, and the first thing that happens is inflation, wild inflation, because importers and this is back in the 1890s, not in 2025. Importers bringing in goods from Europe, and they have to pay the tariffs before they can get their hands on them. And of course, they have to pass these price increases off to the consumers and their manufacturers who are using the raw materials. And that caused a global depression that lasted for many, many years. In fact, the House of Representatives, I believe, turned to Democrat for like the next 50 years. Okay, and this happened again. And you remember the market crash in 1929 when everybody was buying shares, and suddenly the market was so overvalued. Those who had the shares sold them all, and the markets collapsed. Well, for many, many years, people thought that 1929 massive crash caused the global depression. Well, it really wasn't. it was the tariffs that came the next year. So there was two representatives called Smoot and Hawley who created this great plan to charge tariffs to every other country. And of course, the same thing happened. Every other country put on reciprocal tariffs, and a global depression ensued. But it was far worse then because, I mean, nowadays when something happens, it hits us within a split second because we have the internet and we have lightning fast exchanges. In those days, it took months and years before the depression in the United States hit Europe, and of course that brought on the rise of fascism in Germany in the early 1930s, which led to the Second World War. So these Smoot-Hawley tariffs were one of the most devastating things that ever happened. What I'd like you to do is, I'm not going to go through the whole thing right now, but Ronald Reagan gave a speech in 1987 about tariffs. Just go onto YouTube, Google, or search for Ronald Reagan's 1987 speech on tariffs, and it is the clearest, most concise, it's very short, it's only a few minutes long, address to the American public on the cause and effect of tariffs. And basically he said, what tariffs do in the United States is they hurt American workers. They simply don't work. And one of the first things that happens is when you put a tariff on something, the country who's being tariffed puts a reciprocal tariff on you, and the whole thing becomes a house of cards, which is what we are seeing now. So Ronald Reagan had it right, but unfortunately the current administration didn't go onto YouTube. They didn't listen to Ronald Reagan, and here we are again. So what are the effects of tariffs? Well, first things that happen, of course, is inflation. Once American importers realize that China and Canada aren't paying these tariffs, they're paying the tariffs. So when an importer pays the tariffs, doesn't matter whether it's for avocados or for Chinese toys or for oil, they have to pass that on to the consumer. In fact, you're finding right now that I was watching Bloomberg today, they were talking to Nestle. Nestle's sales are way up because they're already passing on the cost of these tariffs onto their consumers, their distributors, which is chocolate and drinks and everything else that Nestle makes. And one thing that you need to keep in mind, these are big businesses, and they have an obligation not to their customers but to their shareholders. So when they have to suddenly start spending tens of thousands or hundreds of millions of dollars on tariffs, that is an asset that they can't use. So they don't just pass that on to the consumer. They have to pass on that money to the consumer plus a percentage to make up for the money they're losing by not putting that capital to work. So it's a very complicated situation. So the next thing that happens with tariffs is trade wars, and we're seeing it right now. We saw it during the first Trump administration. And then you get into exports that just simply fall with trading partners. In fact, recently, European car exporters have just simply stopped exporting to the States. They are simply not going to send more cars to the States. It doesn't make any sense. By the time you get them there, you build them, pay the tariffs for building them in the first place, send them off to the United States on a ship, which costs a lot of money. And then suddenly this vehicle you're sending, whether it's a Jaguar or a BMW from Germany going into the United States, suddenly costs another $10,000. It just doesn't simply make sense. So what they're going to be doing is, and a lot of companies have to just ride the storm right now. And again, and industries have to adjust. They're saying, well, we simply can't afford, we can't sell the products, we can't build the products. So what happens is, they have to lay off workers, and it's already happening. A lot of companies are laying off thousands of 900 workers here, 1,000 workers there, and companies like Ford and John Deere makes farming equipment. They are a stalwart of the American industry. They've been there forever. They're now moving production to Mexico because it doesn't make sense to stay in the United States. Ford and the CEO of Ford went to Washington just this last week. Not to try to negotiate, but just to say to the president, we have to do this. We simply have to move production out of the United States into Mexico because we simply can't survive. And as I said earlier, a typical car requires about 30 or 40,000 parts coming from 40 different countries. So it's physically, even the paperwork handling the tariffs is astronomical. So you've got industries don't want to fail. They have an obligation to their shareholders, and they have to survive, and they'll do that by laying off workers, moving production outside. And it's not like they can find different suppliers because everybody's been affected by tariffs. So here's the next thing on our list is uncertainty. And this is the worst word if you're a trader or if you're an investor. That's it. I mean, if you're an investor or a trader and you have good news or bad news, you can adjust. If you have uncertainty, that's the worst word for everybody because they simply shut down. You sell your stocks, you go to cash, you don't make decisions. If you're a company who needs to innovate or do research and development, you simply stop because the uncertainty is too much to handle. So these are the effects of the tariffs. So uncertainty, as I was just saying, investors and companies can't invest. There's uncertainty. We have big sell-offs, which we've seen recently. The idea of going to cash, getting out of stocks. You will note, if you take a look back at your charts for the 2008 market collapse, you will see that the American dollar got very, very, very strong very quickly over months. And that's because when people sell their shares on the S&P 500 and the NASDAQ, they have to go somewhere, and typically it's to cash. So what's happening now is the exact opposite. The American dollar is getting weaker while the stock market's going down. So it's a very strange situation. And the bond market is also failing. I'm not going to get into that because that would be far too complicated. So we've got a lot going on that the global economies really don't want to see. Typically in times of trouble, the money goes to safe havens like the Japanese yen or the Swiss franc, or U.S. T-bills. Well, that's not happening now because the U.S. simply because there's so much uncertainty with the American economy. The U.S. T-bill is no longer the most amazing, secure thing to go into. Right now, it's gold. And I found this chart literally today. I was watching Bloomberg, and I was quite shocked by this chart. They have the uncertainty chart, and you can see over 2018, 2019, 2020, uncertainty was quite high based on the first set of trade wars, and then COVID. Of course, COVID caused a lot of uncertainty, which was obviously logical. But you can see now that the current uncertainty in 2025 is towering over. It's like 3 or 4 times, well, 2.5 to 3 times more intense than it was back in 2020, even during COVID. So that's definitely not a good sign. And again, if you hear the word uncertainty on the news, it is the dirtiest word in the vocabulary of the investor or the trader. Okay, so what was the plan? I mean, I say what was the plan? Well, let's face it, there was no plan. Does Donald Trump want to create a legacy for himself? I mean, really, who the hell knows? We just don't know. And anybody who says that Donald has a plan or it's the art of the deal or he's negotiating, I'm sorry, I don't believe it. It's just, he's making it up as he goes along. I don't mean to be mean or try not to be subjective or objective, but all the evidence points to the fact that there really is no plan. So Donald Trump had the idea that he's going to raise revenues because the American economy is in serious debt. I mean, trillions and trillions of dollars. Who owns that? Who holds that debt? Well, the Chinese do, which is never, not a great situation. And a lot of the American revenue goes to pay off the debt. So Donald Trump had this great idea, was that we could use tariffs to raise revenue to pay off the debt, and just simply, as I mentioned earlier, and going through history in 1890, and they tried that the same, and it just didn't work. So Donald Trump's idea was that they're going to raise these tariffs. China and Canada and Mexico were going to pay the tariffs, and then the American Treasury would reap in all the rewards, which is absolute nonsense, because this was not the exporting countries paying the tariffs. It was the importers. And why it took so many months for Donald Trump to understand this, we have no idea. We can only speculate. And the other side of the coin was to encourage companies to build in the United States. He wanted to bring industry back home, which is a very noble cause. But the opposite is happening. As I was just talking about John Deere and Ford, they're moving out. And the products aren't coming in, the products can't afford to come in. It's actually doing the opposite than encouraging companies to come back and build in the United States. So basically, you can't do both. It just doesn't make mathematical sense. You've got like a company who you're taxing and taxing and taxing on their raw materials or their products coming in, and then you want them to invest in their own companies to build in the United States. It just doesn't make sense because you're taking away with one hand, then you're expecting them to do something else with the other hand. It's not physically possible. Never mind they don't have the cash anymore, but again, there's that word, the uncertainty. Who wants to invest when there's so much chaos and uncertainty? So you can't do both. You use tariffs to raise income, which doesn't work anyway. If you want to encourage companies to come back to the United States and build in the United States, it will take decades to do that. As they're saying, you can't just flick a switch in an auto, building transmissions and suddenly move them from Mexico or Japan into the United States. It's a very precision. Building a transmission is a huge deal. It requires a lot of precision. And there's, as I said, there's 30 or 40,000 parts to a car. You can't just flick a switch and have everybody move back to the United States. So it's just not going to happen. If you're a company who wants to bring things back to the United States, there's a lot of work to do. You need to find experts who can do design the product. You need to work with state governments and local governments to get tax credits to build the factory, and you need to make sure you've got the labor and talent to do it. So this doesn't happen overnight. So the idea that they're going to whip on some tariffs and have everybody come back to the States to build things, it was just fantasy, and it's already, the idea is already collapsing. We're less than 100 days into the Trump presidency, and it's just not going to work. So, and as Ronald Reagan said, when tariffs come on, you've got trade wars, retaliation, domestic and international retaliation. You've got companies who are changing suppliers, cutting suppliers, looking for new markets, or simply moving out. In fact, take Canada, for example. Canada has put and I don't want to talk about Elon Musk, but they're putting a 200% tariff, I believe, or 100% tariff on Teslas. So they're changing their tune. They're not going to be bringing in electric vehicles from the States. They're negotiating now with Europe to bring vehicles in. They've suddenly realized they can't sell into the United States, so now they're doing deals with China and other parts of the world, especially Europe. So the whole global trade situation is being upended and changing quite quickly, and to the detriment to the United States. Okay, we need to talk about the U.S. Federal Reserve and the concept of central banks. And I realize now I'm running a little bit behind, so I'm going to quickly zip through this. Every country has a central bank independent from government. And the current chair of the U.S. Federal Reserve, which is the American Central Bank, is a guy called Jerome Powell. What these people do, they make decisions based on data, independent of government, independent of Congress or the president or the prime minister, depending which country they're in. They take a look at the data and they try to control a country's currency and inflation rates based on what they see with inflation rates and employment figures. So Jerome Powell and his people will look at the non-farm payrolls every month with great interest, because they need to set the interest rates. And basically, now that the inflation is coming down after COVID, after the situation in Ukraine caused the natural gas prices to go up and cause more inflation, inflation has come down. The central banks like to see 2% inflation, and they're happy, so they can bring interest rates down. But unfortunately, Jerome Powell and his people and most central banks can't make decisions now because of the uncertainty. So it's a bit of a double-edged sword. And what they don't want to do is irk the government, irk the president. But it's kind of hard to make a decision and carry on when you really don't know what's going to be happening week on week. So I'll quickly touch on monetary policy versus fiscal policy. You've probably heard these words over and over again. Very quickly, the central banks deal with monetary policy, raising and lowering interest rates, in easing or tightening, and what that means is buying and selling bonds. So basically, if The central bank buys bonds, they're injecting money into the economy, which in turn will bring the currency down and interest rates down. Governments, which could be the president or Congress, their job is to raise or lower taxes, to spend money, and in this case, create, raise, or lower tariffs. Normally, in the United States, Congress is should be the ones who impose tariffs or raise and lower taxes. But through a loophole, Donald Trump has been able to do this, and that's basically a War Measures Act. Basically, if the way it was written, if the country is under threat, under war, under national security threat, then he can take over and do things. And he's really stretched the definition and the spirit of those rules. But that's a different topic. Okay, so what are the effects of the tariffs? Well, basically, here we are looking at the NASDAQ. This is a weekly chart, and you can see what's happened. If you go back to February of this year, there's suddenly a massive drop into April of this year, which is where we are now. So if we take a look at this chart, and we see price action right now is at the same level as December of 2023. So from 2023 to 2025, you've lost all those gains. So anybody who had long-term investor in the stock market has lost all their gains in literally a matter of a couple of months. So that's where we are now. And I show and if you look at any index all over the world, it's pretty much the same story. All that has come off based on the tariffs. Okay, what's really interesting to look at, and I spotted this straight away, is that there are four major indices in the United States. There's the Dow Jones Industrial Average, which looks at the 30 largest companies. There's the S&P 500, which looks at the 500 largest companies. The NASDAQ 100, which looks at a lot of tech stocks, pharma stocks. They don't have any banks on them. And there's the Russell 2000, which is a small cap index looking at smaller companies. What's interesting is that if you look at the percentage loss of each index, that the Dow Jones Industrial Average lost 15% and the Russell lost 26%. And the reason being is that these smaller companies have less capacity to recover from losses like this. So the big boys, the big banks and the big companies lost less in their share price and their market capitalization because they have enough capacity to carry on and weather the storm. Okay, so here we're talking about a news fake out, and this happens a lot, and it doesn't just happen during tariffs, and this is where you can really take advantage, and I'm going to show very quickly what happened very recently. So you can see my little purple box there where we've got prices going up. Just last week, in fact, I look at the chart, it was April the 7th, April the 8th, where there was an erroneous report out of the White House saying that there was a 90-day pause on tariffs. Well, that's great. Then the NASDAQ and all the other indices shot up. So if you take a look at this, there was 8 candles, which is 32 hours. So you had 32 hours to hear the news and perhaps go long on any of the indices. So that's a lot of time, 32 hours. So you can, in fact, take advantage if you're paying attention. So what happened, though, when you can see that there's a big, suddenly a bearish candle. What happened was that was a mistake. The White House actually they were not going to offer this 90-day pause. So the White House corrected the story, and look what happened. The indices fell again. And they fell right into support. So here you have an opportunity, which is where you can combine fundamental analysis and technical analysis and really take advantage. So this is what happens. This doesn't just happen during tariffs. It happens during many market events. It can be, like I said, rebels taking over an oil tanker in the Suez Canal. It could be another attack on the Ukraine or Russia or vice versa. These things happen all the time, and you can see the big market movers. And it's happened very often where there's been fake news or a mistake. Markets move, whether it's the price of gold, whether it's indices, and basically you can take advantage of these things. So here we are, where the White House saying, no, we're not offering a 90-day pause. So suddenly they came back and says, oh, oops, wrong way. There is a 90-day pause, and the price is shot right up. So everybody says, oh, fantastic. So they got back in, they bought in, and the prices shot up over the next 16 hours. Okay, so this is up and down, up and down, up and down. I know it's hard to keep track, and a lot of uncertainty is still, huge uncertainty and chaos is still going on. So not every investor is going to pile back into the markets. Okay, the reason it came back down again was that the White House announced 125% tariff on China. So here we are, U.S.-China trade wars again, just like in Trump's first term. And the markets, and there was a big sell-off. So you had 28 hours of the markets dropping. So we're going to have this over and over and over again. And in fact, I remember last time everything was tweeted. Everything was done on tweets. In fact, even Steve Mnuchin was tweeting and causing markets to go down. He says this. China comes back and says, no, that's not quite true. It's going to be like this, and the markets go back up. So if you're paying attention, you can actually catch these waves up and down. Okay. Just on the weekend, last weekend, Trump got upset and he wanted to talked about firing Jerome Powell, the chair of the central bank, because Jerome Powell wasn't lowering interest rates. Well, Jerome Powell can't lower interest rates because it doesn't make sense. He doesn't have the data. But unfortunately, if Jerome Powell lowered interest rates, when interest rates are lower, it makes the currency go lower, but it also helps the indices. Corporations like low interest rates. So if the interest rates are lower, the markets may recover and Donald Trump will look better. So I can only assume that he's upset with Jerome Powell for not lowering interest rates because of that. So what happened was, and the markets did not like that at all because they rely on central banks for their information. So to say they're going to fire Jerome Powell and put in someone who may be less empirical and not follow the data it could be bad news. So the markets fell dramatically. So you had 20 hours of price falling. And again, this happened over the weekend. So Monday morning when the markets opened, boom, 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 it went down. Okay. Right. So then Donald Trump softened his, very recently, like I'm talking yesterday, day before, he said, oh, I wasn't going to fire Jerome Powell. And he suddenly started talking soft on China and tariffs, and they're not going to be zero, they're going to come lower, et cetera, et cetera. So the markets people piled back into the markets, and you can see a big price gap there. So this is going to be happening for many months now, maybe even in the next year. So the bottom line is, if you're paying attention to the news, you can take advantage. The difference trading here, and this is very important. Swing trading and position trading are going to be very difficult because you just don't know what's going to happen. So short, sharp moves are the name of the game. And you can see this actually happened over 40 hours, which is actually quite long. Okay, here we are. We want to combine technical analysis with our fundamentals. And here I do this very, very often. I trade news all the time. So here we have the NASDAQ on the 4-hour chart. And you can see a big fat double bottom there. And again, you probably wouldn't have traded the double bottom under these circumstances, but you can see in almost every case, these fundamental events, good, bad, or indifferent, drove price into a trend line. So you can use your technical analysis to catch a reversal. If you miss the big move going up or going down, you can use technical analysis to get back into the markets and trade with the trend. Okay, here we are. I'm showing you how the stochastic oscillator paired up very nicely with these big market moves. And this is that you need to take a look at these, back test, and always trade with the trend. Okay, you could also take a look at MACD or any other indicator that you like. Okay, I use MT5 profiles or CTrader workspaces to analyze the markets, and I can highly recommend that you take a look at your combine all the indices onto one chart. You can see now pretty much they're all pretty much running in lockstep. So in this case, I've got the U.S. indices with the FTSE 100. You can see that the FTSE 100, though, which is the UK index, is slightly different. It's actually looking more optimistic. So this could be a clue for finding another opportunity. In fact, if we go to the European indices, they're even more optimistic. And the Europeans are preparing for the tariffs. They're finding new trading partners. They're working with Canada, working with China, cutting back on their exports to the United States. They're talking about lowering interest rates as well, which has irked Donald Trump. So the indices may be recovering a lot faster. So this is another opportunity for you if you follow the news as well with the European indices. This is the CAC is the French, DAX is the German, Stocks is European, and as I said, the FTSE is the UK. Right. So using MT5 profiles as well, I can take a look at all of my euro pairs. These are all in daily charts, and you can notice right now that euro is quite stronger, is a lot stronger than most currencies. The reason is that they are reducing their trade surpluses with other countries. Their defense spending is up because there's an impending problem, obviously a big problem with the Ukraine right now, because they simply can't count on the Americans anymore. That's a different topic. So the euro is actually getting stronger. You notice as well, it's not getting stronger against the Swiss franc because, again, I said the Swiss franc is a safe haven. So you can use these opportunities. And again, using the same strategy of waiting for news, whether it's tariff news or regular news, to drive euro. It doesn't have to be euro dollar, could be euro yen, could be euro CAD, into a technical opportunity, and then trade with the trend. So, and I say always trade with the trend. Don't try and go against it unless you're really, really brave. So, okay, Nick has popped. Hi, Nick. Thanks for the question. We're not going to be giving away some accounts, but if you wait till the end, there'll be some special surprises for new traders. So, almost is the answer to your question. So, anyway, getting back to my little chart here. So, if you want to pay attention to the news. News drives price action. We need to monitor your key levels, support and resistance, monitor your indicators, and monitor chart patterns to take advantage of fundamentals driving price action into a technical event. That's how I trade. Trade the reversal when it's safe. So always make sure it's safe. Look for confirmation, and also make sure you can put a stop loss. If price is going into the stratosphere and there's no place to put a stop loss, as far as I'm concerned, there's no trade. Okay, gold. Okay, so this is gold typically moves up and down with geopolitical events. That's the way it is. That's the way it always has been. Nowadays, though, it's becoming far more important because central banks all over the world are buying more gold, stocking up on gold. They're buying and buying because gold is holding its value, and it was recently at $3,500. So to trade a reversal on gold might be a bit reckless right now. To scalp gold might make sense. Zooming into a lower time frame might make sense on gold. So don't forget the value of the American dollar, if you're trading XAU USD, will also impact the price of gold, and that's our safe haven right now. So basically, what can go wrong? Buy gold or not buy gold. The thing with gold is, though, as soon as things calm down, any good news, the price of gold may come down. So I want to show you something that's really, really interesting. This happened during COVID. So obviously COVID was an earth-shattering event, and you would think with COVID that the price of gold would go up. Well, not in this case. The price of gold went down because banks and funds had to balance their portfolios, and the way to do that was to sell off the gold. They had to sell off their stocks, which meant that they went to cash, but they also had to find more cash to offset the losses, and they sold their gold. Could this happen again? Well, I'm going to go back to the first slide. The central banks are buying and buying and buying. If things get really, really bad and the global economy heads into a depression as opposed to a recession, central banks may have to start selling gold. And that's a case where, and hope it doesn't happen, because there'd be a lot more troubles, a lot more problems than just the value of gold. So that's another opportunity. We hope it doesn't happen. Okay, crude oil. Basically, there's really no tariff situation where you can use it to your advantage to trade crude oil. And crude oil is basically going to go up and down with supply and demand. So if we have a recession, that means lower demand. You may recall during COVID, the demand for crude went way, way down because nobody was traveling. In fact, you remember on the spot price was like, the futures price was like minus $40. The spot price was $9. It was insanely cheap because there was no place to put it. There was a storage problem. So basically, if you want to trade oil, you need to keep mind of the news, take care of what OPEC is saying, monitor what they're doing with their production levels, because this will drive the price of crude oil. Also, these days, for many decades, the Canadian dollar has been that's not true, has been influenced by the price of oil. So if the price of oil goes up and down, the price of the Canadian dollar, the value of the Canadian dollar will go up and down as well. So again, crude oil is not going to be affected directly by tariffs, but it will be affected by the state of the economy, the strength of production, the level of production, and the demand for crude oil. And you can see right now on the chart it's come down quite a bit, both Brent crude and WTI. Okay, right, so I've been asked to talk about the future. Well, the problem is the future is very difficult when you've got Donald Trump steering the ship or trying to steer the ship. And I'm going to use the phrase that you can't put the genie back in the bottle. So what do I mean by that? So what genies come out of the bottle? Well, as I said earlier, every nation on earth was encouraged after COVID to replace China as a supplier. Well, now everybody's going back to sell to China and to buy from China because the Americans are becoming a very unreliable partner. So basically, this is the genie that's not going to be put back in the bottle. And it's not just about buying semiconductors or toys from China or shoes from Southeast Asia. It's about the debt that China owns. It's now that the United States is killing off things like US aid programs, China can come into certain countries and pick up the ball and loan money. And basically get into a situation, and I don't mean to badmouth China, but this is a situation that the Americans were trying to fight against for decades, and they've actually sadly encouraged the situation to reappear. So this is you can't put the genie back in the bottle. In fact, now the Canadians, for example, I use that as an example, are completely changing their economy. It's incredible what they're doing, and they're going to be selling a lot more oil, potash, you name it, to Europe and China as opposed to the United States because they simply can't count on their biggest trading partner anymore. And again, once this is started, once this infrastructure is in place, they'll have no reason to change back. So it's going to hurt the United States literally for decades. Inflation. One thing Donald Trump said that was true was once prices go up, it's hard for them to come back down. And that's just simply market forces that are going to drive that. They've completely disrupted supply chains, manufacturing chains. And for U.S. exports, they become the unreliable partner. They become the unreliable boyfriend. There's also security risks. Never mind that no one's going to be buying F-16s. In fact, Canada canceled a huge order for F-16s. China's sending back their Boeing airplanes to the United States, not just as a retaliation, but also as a security risk because the Americans, sadly, for their, have literally shot themselves in the foot in terms of a supplier and a security partner. So it's simply a bad news all around, and it's going to take the Americans a long time to recover. Okay, I'd like to thank you very much for your attendance. If you have any more questions, just feel free to pop a quick note onto the Fintokei customer service people. If you have any questions, you can send them to me directly. And I hope this made sense. Hope you understand about how the tariffs work, how to combine fundamental analysis with technical analysis and make your trading a lot more profitable and a lot more fun. And again, the bottom line is you may need to get away from position trading and go back to scalping and swing trading to ride the roller coaster that is the U.S. economy right now. Thank you very much, and I'll talk to you soon.